Hello, thank you for joining Securities Analysis for the Rational Investor. Today we're going to look at a very large, very well-run company, Apple. This is Apple's 10K. It's their annual report. They publish all of their financials here, all their disclosures, management's assessment of the business, some of the detail on how they account for their costs and how they do what they do. We're going to go through this very quickly to show how you can look at Apple's historical earnings to get a better understanding of how they might perform in the future. And then with that future performance, get a comfort around what you think their value may be and whether or not for you that is a proper investment going into the future. This is the way I look at securities. I want to talk to you about it and see if there's if you agree, if you disagree, talk about it, because I absolutely love looking and valuing companies, and I expect that this channel is going to be just a continuous series of 10K discussions on good companies, bad companies, companies that are difficult to judge, all of them. So this one, we're going to talk about Apple, and we're going to approach it from our foundation, which is a couple things. One, top-line revenue growth. It's what we want to see, long-term top-line revenue growth, earnings growth, strong cash flow, solid balance sheet, and hopefully well-priced, that you can step into that at a reasonable price with some protection and feel that over the long term you will make good return. What that return is, we're going to try to take a guess at it, but ultimately who knows what the future holds. If anything, the recent COVID-19 virus has proven that any forecast is going to be wrong. No one ever, I think, anticipated something like this happening. Now we're all dealing with it, and whether you like it or not, the market is down. It's down significantly, and while your portfolio is most likely down, it does mean that great stocks are on sale. So let's go hunting. Well, my philosophy is that America will continue to prosper. I'm young enough to want to buy stocks for the long run, and this channel is dedicated to the search for value in stocks for the long term. So let's talk about Apple. I'm going to walk you through the framework I use to value stocks, and it's two things. One, cash flow. What does cash flow look like historically? And what is cash flow going to look like going forward using the kind of average cash flow that we've experienced? That's the first method, typically called the discounted cash flow method. The next method is a market multiple method. For here, we're going to use an enterprise value to EBITDA multiple to show where Apple has traded in a range historically, where it is right now, and where, given that range, it could be in the future with some simple growth to a few earnings numbers, just continuing the growth that they've experienced. And what I've found is that when you look at things on a 10-year time frame, hiccups, let's hope COVID-19 is a hiccup, but hiccups like the COVID-19 that will depress earnings or GDP for a quarter or two, become mere simple speed bumps in the acceleration of the economy. And I'm optimistic enough that in 5-10 years from now, there are securities out there that you want to own that will be here in 5 and 10 years from now. And the trick is, how do you find them? How do you make sure they're safe and to invest in? And that's what we're here to do. So let's dive into the Apple 10K. And let's find out, how do we come up with free cash flow. So what we'll do is we're going to start with the 10K, and we're going to go to the cash flow page. Cash flow page is on page 33. Cash flow page look like this. Right? And what we want to do is we're going to focus on operating cash flow. Operating cash flow is right here. You can see operating cash flow, and that number, $69 billion of operating cash flow. Now that is cash money. cash money, not earnings. Earnings is sometimes not cash. This is cash that Apple generated while operating their business or during the 12 months of 2019. Prior to that, it was 77 billion. Prior to that, 64 billion. So in 3 years, they went from 64 billion to 69 billion. That's operating cash flow growth. That's what we want to see. That's the first number that we need when we're looking at free cash flow. The second number is CapEx. CapEx, again, is investment in property, plant, and equipment, or other assets that the business is going to need to maintain the cash flow from operations. So it would be investing in systems and technology and painting buildings or buying real estate, developing server rooms, what have you, that are large capital investments that they need to sustain themselves. That would be 5 lines down under payments for the acquisition of property, plant, and equipment. And I think it's right there. And that number for 2019 is $56 billion. I'm sorry, I read the wrong number. That is $10 billion, not 56, 10 billion. So we have 69 billion of earnings minus what they have to reinvest in the business, about $10 billion. The next thing we want to look at is the debt financing of the business. Are they issuing debt? Are they paying down debt? But basically the sum of both money that comes in and money that goes out to lenders, you want to take that sum and you want to add it to this string of cash flow that we're looking at. So what we're going to do is we're going to go down the financing section and we're going to look at proceeds from the issuance of debt and the proceeds paid to debt, the repayment of debt. Specifically, term debt is what we're looking for. So you'll see it down here in the bottom. It's tough to see in this camera. I think that's it right there. Repayment of term debt. And you can see over here, net is $1.8 billion. Now, Apple is interesting. Apple, for the long time, had no debt whatsoever, zero. Okay, zero long-term debt. That's what we're talking about, bonds. And over the last 5 years, from 2013 to 2018, they have been issuing debt. They have been leveraging the balance sheet and taking that debt. They've been investing in CapEx. They've been rebuying shares. They've been paying dividends. They've been doing a lot of things. But that debt can be paid out to shareholders and it can be invested in new CapEx. But it's important to include it in the free cash flow to equity because much like a home that's paid off, you can borrow on that from a home equity line, and you can take that home equity line as the owner and go spend it on a jacuzzi or a backyard remodel. You can spend it on buying a new investment property. It's your cash, and if you borrow it, you need to make sure that you count that as free cash flow. So here we're adding cash flow from operations. We're subtracting the CapEx that they put back in the business to sustain ongoing operations. And we're subtracting the net debt. So if they paid out money, that's a negative. If they received money, it's a positive. So you add up those numbers and you get free cash flow to equity. And Apple's free cash flow to equity is $57 billion. Now that is money that you could conceivably light on fire and it would not affect the business. You've paid for everything. You could take all $57 billion and just dividend it out to shareholders with a massive gift to the shareholders. There's lots of stuff you can do with it. So we're going to treat that as though it's been dividended out for our purposes, and we're going to treat that as cash flow that we can use. The next number we want is the number of shares outstanding. The number of shares outstanding is going to be on the income statement. It's right underneath the income, net income, typically on 10Ks. And in this particular 10K, the income statement is on page 29. And you can see shares outstanding, both diluted and basic, underneath the income. So here is income, net income, and here's your share price, or excuse me, earnings per share, and here it is, the shares outstanding, both net and diluted. Diluted would be if all employee stock options were exercised, if any convertible debt was converted into equity, basically anything that's outstanding that could be turned into equity, if it were to be turned into equity, that's how many shares were outstanding. That's the difference between diluted and basic. So here we're just using the basic earnings because we're trying to get a yield. If we were doing, we'll use fully diluted, another example later on. But basically, the basic earnings, 4.6 billion shares outstanding. So what we're going to do is we're going to take our free cash flow that we calculated, the 57 billion, and we're going to divide that by the 4.6 billion shares outstanding to get $12.36 per share. That's free cash flow. That's cash flow that could be dividended out. It could be used to buy back shares. It could be, whatever the management wants to do with it. But the important thing is we know it's $12, $12.36. So what we do is we'll take that $12 and we'll divide it into the share price average for December, the year end, which was $276, and you get a yield. A yield is think of it as like a coupon or an interest payment. The way you can think of a yield is synonymous with interest payment. Sorry, my screens just went out on me. So that payment as a percentage is 4.5%. And I'm going to show you all this stuff in a second in a chart, but just kind of walking you through the math for a second. 4.5% is the yield. And then what we'll do is we'll look at the yield change over time, the growth rate of that yield. Has that yield gone up or gone down? Because that's important. And we'll take that and we'll string it out in the future. So let me show you this. This is that exact line that I went through. Cash flow, all the way to shares, yield, and then growth rate for every year for a decade. Right? So there in the bottom, you can see this bottom line is 2019. You can see all the numbers I referenced, and then off to the side here you can see there's the yield, there's the growth rate year over year, and down here I've put averages. So that's an average yield and average growth rate for the full decade. And what's interesting is Apple had an average yield of 9.7%, call it 10%. Okay, so it's average free cash flow to equity yield is 10%, and that 10% has grown over the decade at an average rate of 14.5%. Very strong. Strong yield, strong growth. So what I have done, I've taken that 12.36 of a free cash flow per share, and I'm assuming that's going to continue on into the future for another 10 years. And what we'll do is instead of growing that at 14%, because obviously as they get bigger, they're going to slow down. So I'm assuming an average, let me see what this average is. The average growth rate for the next decade would be 10%. So if the previous decade was 14%, the next decade is going to be 10%. Take the 14. I'll show you. Take the 1236 of free cash flow equity. You grow that at 14%. You get $14.17. You grow that down in the future to 2029. At the end of 2029, 3257 is the assumption. That assumption is the dividend or coupon that you could receive. If the company's yielding, I chose 8% at the time, just a little less than the 9.7. You get a stock value of $394. Now, is this the stock value that's going to be there in 10 years? I have no idea. Right, 10 years is so far away. We couldn't see COVID-19 coming 6 months away. I don't know. But what I do know is that Apple has been growing for a decade. They've been growing at a high clip, a double-digit clip, given that they were already a billion-dollar company. Then they went to a trillion-dollar company. So they've already been growing. I'm assuming they're going to continue to grow, which is an assumption. But that growth rate is slower than what they have been. So I think it's decent. And I've given it a decade. So they have a long time to get there, even with this COVID-19 blip. And so what you can do is you can then discount that to present day and come up with a valuation for what, or rather, you have a rate of return, right? So you've got the current share price of the stock. Let's see, it's down recently, so it's $246. So you can buy the stock today. This would be an assumption if it's something you want to do. You can buy the stock today at 246. You can hold it for a decade, and every year you'd get theoretically a coupon of a yield that's about 8% or anywhere between 14 and $30 as a dividend over the decade. And at the end of that decade, you'd sell your stock for $394, and you would get an IRR of 14%. So what does this mean? This means that if you bought the stock today, according to this model, you would make 14% right, internal rate of return every year on the stock over a decade. This is a math exercise, essentially what it is. It's laying a framework out. It's following the math to come up with a valuation. Do we think it's right? I don't know. You got to smell check it yourself. You got to just make your own assumptions. You have to say, is this something that I believe in? Is it right for me? But it's how the math works. Charlie Munger is always a fan of saying that a man with a hammer, every problem looks like a nail. This can be true here. This is a math exercise. You still have to sit back and say, is it rational? Can Apple sustain their positioning in the market? The iPhone sales are a big piece of their overall business. Is that going to continue? I have no idea. And this is not an advocation, by the way. I'm not advocating the purchase of Apple stock, by the way. This is not a recommendation to buy any security. This is simply walking through the math, coming up with a valuation, and saying, does that smell right? And to me, I think that can happen. $394 is not a huge gain over a decade, considering what they've been growing at. I think that's reasonable to me. I also look at what the company's done in the past as a very good gauge that they would be able to do something to that effect in the future. It's certainly better than going to some of these spec stocks that are hemorrhaging cash, and you're expecting them to turn cash flow positive in the future. Look at Uber of the world, or I think we did Uber technology last week. There's a company that's not making cash, is not projected to produce cash flow positive in the near future. It has a crazy value. So at least here I know I'm getting a cash dividend at the very least. They're already cash flow positive. The hurdle rate to get from the $246 share price to the $394 is a little bit more reasonable if you smell check it, versus an Uber that's going to go from cash burn to cash positive, which could be much more difficult for them. So that's free cash flow to equity. What I like to do is I like to say, you come up with two different ways to value a company, and you can kind of blend the two to see which one you really want. This one is free cash flow to equity. The other one is an enterprise value to EBITDA, EV to EBITDA. What is EBITDA? Earnings before interest, tax, depreciation, and amortization. It is a proxy for the free cash flow number we just came up with. It's often used in banking, or when you're quoting how much a company is trading for relative to cash flow. People will typically say it's an EBITDA of X. And typically the bigger you are, the higher the multiple that you trade at. So if you're, let's say, a pizza joint, or at your local strip mall, or an ice cream shop, a hair salon, those might trade at 3 times EBITDA. So if EBITDA is $100,000 a year, you're going to expect to pay $300,000 for the entire business, all debt and equity, everything. As you get bigger, you become more dominant, you have more staying power, like a Coca-Cola, right? A Coca-Cola is much bigger than a pizza shop house. So its multiple should be bigger than 3. It should be 10, 15, 20 times earnings, or EBITDA, excuse me. And that will change with the stock price. So what you look for is you have an enterprise value, which is kind of moving around, and you have EBITDA, which is last year's number or a trailing 10-year average, and you kind of try to find an entry point in a stock where the multiple makes sense to you, and you're willing to roll the dice. So what we do is we track down what we think EBITDA is for Apple, and then look at it over the last 10 years, come up with the enterprise value and see over the decade, what has it traded at, where is it trading now, and do we think it's diverting from its average, and why? So how do we come up with EBITDA? EBITDA starts with the income statement. For the income statement, like I said, we're going to page 29. Let's go back to page 29, the income statement, and we're going to pick up, you can start at net income, and you add taxes, and you add interest back, and you get your earnings before interest and tax. And I'll show you how to do that. That's right here. There's your net income, your provision for taxes, and interest. So that's how you get your EBITDA. Also here, it's basically the operating income line. So what we'll do is we'll take that, and then we'll add to that the depreciation and amortization, and that can be found on the cash flow statement. So if you go a couple pages back, page 33, cash flow, under operating cash flow, you will see depreciation and amortization right there, and it's spelled out annually. You can see Apple's depreciation and amortization last year was $12.5 billion. You've got your EBIT, or earnings before interest and tax, $63 billion. So combined, you got a $76 billion EBITDA. Okay, so now we got EBITDA. Now, how do you get enterprise value? Enterprise value, we have one piece of it already. We've got the number of shares outstanding. We said that's 4.6 billion. You know, the share price, the average share price in December of 2019 was $276. Multiply this together, you've got a market value of $1.27 trillion. That's still difficult to say, but that's the market value. The other two pieces to this, you have total debt outstanding, the long-term debt, and you've got a cash that they have. It's excess cash. So we'll cover that when we get there. Let's do the debt first. Debt will be long-term debt. We go to the balance sheet. Balance sheet is on page 31. Let's see, page 31, and it says long-term debt. It's very clear at Apple. They do a great job laying it out. Let's see, term debt, and then term debt. In the current portion, term debt is 10.2 billion. In the long-term portion, 91 billion. The only difference there is basically the term debt that's due within 12 months. So within 2020, they'll have to pay 10 point. So it's basically their principal payment in the debt for the year. And then long-term is anything past a year. What else is out there? That's 91 billion. So add the two up, you get 102 billion dollars. You got $102 billion, you got 1.27 trillion of market value. Add the two up, you're almost done. The next thing to do is subtract excess cash. Now, why subtract? Because if you came to Apple, hypothetically, and said, I want to buy the entire company, and I want it debt-free. I don't want any debt on it, and I want all the stock. You would have to pay back all the banks. You have to pay the banks $102 billion. And you have to buy all the shareholders out of their stock for $1.27 trillion. But then before the shareholders would let you close the deal, the shareholders themselves would say, look, Apple's got excess cash that from earnings that were generated a couple years ago that they just never distributed out. And that's technically cash that belongs to the existing shareholders. So Apple would kick that money out, reduce its cash balance down to something more reasonable for a day-to-day operation of the business, and then sell you the remainder. And so what we do is just look at the marketable securities line rather than using a complex working capital assumption. Just say, look, if they put something in the marketable securities line, that's cash they don't intend to use immediately. So that's kind of cash they don't need on hand. And that is right there. Marketable securities. All right, so for them, $51 billion of cash that they have just bought, T-bills, commercial paper, anything that's short term but not pure cash. That's a lot of jack. So you're going to subtract that from the debt. You subtract that from the enterprise, from the market cap, and the enterprise value is 1.3 trillion, 1.327 trillion. But who's counting? It's big enough. And I've done that then. I've done that then for the last decade. You can see it here. Right, so that's every year for the last decade, and you've got a market multiple next to that. So what I'm doing at the very end, EV to EBITDA, I'm simply taking the EBITDA we calculated, dividing it by the enterprise value, and that's the multiple that Apple trades at. Last year it traded at 17.4, which is a all-time high according to this. Its low point, 8.2. It happened twice, one in 2012, one in 2015. By my numbers, I've seen other websites have different numbers. They all vary, but the patterning is roughly the same. So I'm fairly comfortable with that. On average, across the decade, the market multiple was 10.8 times. So let's figure out what growth looks like and how to value this in the future using this method. So what we'll do is we'll take the EBITDA that we have last year, $76 billion. We'll look at the average growth rate of EBITDA, 12.4%. And we're going to make an assumption around future growth. And I've said that future growth is going to average over the next decade 4.5%. So lower percent. If you recall, free cash flow is at 14%, or excuse me, average free cash flow is 10%. Average growth rate for EBITDA is 4.5%. Basically, there you're looking at law of numbers. It's just I'm growing 14 cents per share versus 76 billion. It's just harder to grow a bigger number, so that's probably why it's a little less. Also, just to be conservative, to give myself some kind of range on this value. So you take your EBITDA, $76 billion, you grow it on average for 4.5% for a decade, and I get $118 billion of EBITDA in 2028. What you do then is you assign a market multiple to that. So I'm assuming a little lower EBITDA multiple, it's going to be a little higher of 12.7 times, just basically a more recent market multiple. I always thought Apple was under-traded for the first part of the decade. Under 10 for that kind of company just never made sense. But 12.7 times is something I think is realistic for a $1 trillion company. So I've pegged it at 12.7%. That's just averaging the last 4 years to come up with a rough number. That puts EV to that's put enterprise value at 2029 at $1.5 trillion, which is not that big of a growth if you think about it. They're currently at 1.3 trillion, and I'm saying they're going to go 1.5 trillion in a decade. It's $200 billion of extra value. That seems doable in my. I'm not asking them to double, right? I'm not quintupling or 10xing the stock price. This is okay. This is a 4.5% growth over a decade. That's 3 times inflation. Anyways, so what I've got is I've got a valuation here for using the EBITDA method, right there. So that's $1.5 trillion of enterprise value, less debt, plus cash, market cap 1.44 trillion, divided by fully diluted shares of 4.6 billion, gives me $311 a share. So on the cash flow method, I've got 394. EBITDA market multiple, I've got 313. I've got a range. 311, sorry, not 313. 311, 394. Basically, $300 to $400. If I go out a little bit for $300 to $400 is where I think the stock price could be in a decade. Again, where will it actually be? I have no idea. This is my assumption. This is my math exercise. Feel free to check me on it if you want, but I'm not advocating buying the security. So then what I do is to just split the baby and just say, okay, half. We're going to peg the value of the stock at around $350. So here's the IRR. Right? You got years off to the side here. And what I'm doing is I'm saying I'm buying the stock at $246 today. I get a series of cash flows over the years. I exit at $350 roughly in a decade. Over the time, I've been distributed $245 of total cash distribution. I've got a stock gain of $106. Add that up for a total gain of $341 of total gain. I bought the stock for $246, and I get a cash-on-cash return of 2.4 times my money, or a discounted IRR of 13% annualized every year. Look, that's a reasonable expectation. This S&P 500 is supposed to do around 15% a year every decade. Apple is a behemoth within there. It's tough to grow, so it's slightly less than the S&P 500 over the long term, which seems to smell check. And look, they have very little debt. They're growing the top line. They're growing cash flow. It seems like a fairly stable company. And if you're going to park cash for a decade, here you've got a decent shot at getting 13%. By no means is it guaranteed, but you can stick your money into a bond, right? If you bought Apple's debt to get 3.6% annual, right here, 3.6% annual, you would have to buy a bond that goes out to 2042. 2042. That's 22 years from now, and you only get an annualized 3.6% return. That's barely above inflation. So that's one option. It's guaranteed to Apple's credit. But then if Apple's credit goes bankrupt, they've got issues too. If you're relying on their credit quality when you're buying the bond as part of the reason to buy the bond, that it's safe. If it's safe, buy the stock. The stock's already got a coupon yield to it. I think Apple's coupon yield is 1.25% just right now. Plus, over a decade, you've got price appreciation, you've got inflation protection for earnings and growth. You have none of that in the bond. You have no potential upside in the bond. You have no inflation protection in the bond. So, I'm much more of a stock fan than I am a bond fan for those reasons. Other investments, you can hold cash. Right? Stick your money in the bank account. Who knows if we're going to have negative yield? I don't know what that's going to look like. So, look, if you're sitting back and you're saying, what do I do with my money? How long do you want to hold it? My rationale is thus. I've got a decade. The American economy will do well over a decade period of time. The market has taken a bath recently. Stock prices are down. Risks of getting in now, I think, are lower than they were previously if you have the decade view. And I think Apple's a solid company. They fit our criteria. Judge it for yourself, obviously. Make your own decisions. This is mine. Let me know what you think. I'm happy to discuss it. This has been a review of the Apple 10K and how to value Apple security and how to value their common stock. If you want to hear anything else or anything broken out, let me know. I'm going to try to pick something more fun next time, maybe a little dicier. Go back to kind of the risky section and kind of go back and forth. But thank you very much for listening, and I look forward to your comments. Take care.